So welcome everyone to today's New Frontiers in Banking, Financial Markets and Regulation conference. This is a series of seminars which are jointly organized by Consob and Sapienza. It's a pleasure for me to welcome you, those present and those present remotely. And let me immediately pass the floor to Professor Giovanni Di Bartolomeo, who is the Dean of the Faculty of Economics.
So thank you, Marina. I bring with me the welcome of our rector and our faculty and I would like to say our community of economics to all our guests and our students. And this for us is something very important because it's a part of a joint project that we are doing thanks to Marina and Valentina with Consob, and this is just a part of a series of events we organized, and all these events have a similar characteristic, that is they are very high level events. And this is important for our students because it's an opportunity to meet people that work at from different perspectives on financial markets and on economics. And because here we have people that work in the regulation of the financial market, people that work in the research of the financial markets. And it's important to have this dialogue with university, the institutions, and to bring the student into this dialogue. And I hope that you will find some inspiration from this workshop of today. And I hope that this will be useful for your future to understand better maybe what you want to do or what you want to study in the next years. So I have to thank a lot Marina and Valentina for the organization. I have to thank the commissioner and all the other speakers, and in particular I have to thank the Consob for organizing this event with us in the name of the faculty and in the name of our students, because they are the first that take a benefit from this kind of meeting. So I hope that we will have a fruitful day or evening if you want, and that you can learn something, and I thank all of you for the participation. So thank you, and we can kick start.
Now we have Luca Filippa, who's the Director General of Consob.
Okay. Is it working? No.
It's not red, so I don't think so.
Maybe you have to.
No, it's not just.
Okay.
Some technological issue.
Yeah.
So go live. Do you hear me if I speak in this way? Okay. We are here to talk about equity listings, the listings and growth opportunity in the European Union. And this is something which is currently highly debated. You are probably aware that one of the most important political choices which is in place in the European Union is the so-called Capital Markets Union, which has been recently rebranded as Saving and Investment Union. Basically, CMU, SIU is willing to increase the diversification in the source of funding of the European Union companies, and then Federico Cornelli will speak about that in detail, but also to increase the integration across the many national financial markets. You always have probably heard about a comparison between European Union and the States, despite it is not exactly the same. I mean, the size, the geographical dimension may be similar, but we are not talking about a single nation, a single currency, a single set of rules. One very easy thumb rule to identify the size of the exchange business is looking at the ratio between the market capitalization, which is the sum of the value of all listed companies in one exchange, in the States and in Europe, compared to the GDP. This figure is around 180% in the States, while is below 70% in Europe, 64% at the end of the previous year. And within Europe, there is a huge heterogeneity, and unfortunately, Italy is always one of the lowest countries when we compare these two dimensions. We are currently below 40%, 38% is the latest figure. When we look at the evolution of the exchange listing in Europe, we see that there is a trend of delisting, which is always told in the press. If we enter into microdata, we see that for Italy, the number of listed companies did increase by almost 100 companies in the last 20 years. But this is mainly due to the increasing listing in small and micro companies listed on the alternative market. It was called AIM Italy, now it's called EGM, while there is a net delisting from the main market. The situation is the same, more or less, in other European countries. So in the last 10 years, we had a decrease of listed companies. But when we move to the pure number of companies, to the size, to the weight of the companies, we see that the net balance is negative, because delistings in the main market normally affected large companies, while listing on the alternative markets only were able to attract small companies. So the overall weight of the national economy represented in the stock exchange is now decreasing, and this is clearly an issue. Today, we see two papers that are trying to address this phenomenon, which, as I told you, are quite common all over Europe, and I would say also in the States. The first one is looking at the incentive behind a firm decision to delist from a stock exchange, because when looking at the phenomenon, we have to ask ourselves what are the reasons, what are the driver of the decision of entrepreneurs to weigh the benefits of being listed against the performance that they can improve with the delisting. And according to the study, several factors may influence the delisting. So the regulatory uncertainty, which is clearly something affecting all the costs and practices that the company should put in place in order to comply with the rules, the agency cost, and the economic performance. And clearly, the model developed by the economists here present affirmed that the firm delists when the economic benefit is outweighing the agency cost, and explain the rise in voluntary delisting globally, influenced also by external macroeconomic factors. The second study presented today is analyzing the so-called regulatory overreach hypothesis, so that there is an excess of regulation, and this is threatening companies to access the market or to remain or to decide to leave the market. And the study is based on the prospectus analysis, which is the document that companies are due to publish in order to explain the business they are performing, the way the governance is managed, and the use of the funding they want to collect, explain it to investors. And there is a parallel between the let's say light prospectus that were allowed for certain companies, and the positive impact of these light prospectus is showing that probably there is an opportunity in reducing this kind of regulation. But I think I have closed my time, so I thank the University of Roma Sapienza for having organized this meeting, and I invite you to pay attention now to the papers.
So actually, before we go to the papers, we have the keynote speech regarding the re-equitization of Europe by Federico Cornelli, Council Commissioner. When we started thinking about this seminar, he suggested this topic. And I must say, it was before we all read the Letta report and then the Draghi report. So actually, Federico was great in anticipating the role of capital markets, the need for a greater CMU, a more effective CMU, and also the need for more equity. So Federico, thank you very much for being here. The floor is yours.
I will be around you, so you will not connect to your telephone. Wonder where you come from. Maybe. Which country you come from? Italy, India, Azerbaijan, Iran, Turkey, Gambia, Turkey and Germany. Willkommen. Nothing else? Belgium? No Belgium. Now, re-equitization of Europe. Why do we need equity? This is very important. Mi vai alla slide number 1. Following number 2. This one. 100 years ago, this was the financial markets in Europe, in the world. US and had a slice of, at the end of the century, before the First World War, US had 14% of financial markets. Belgium, there are some Belgium here. 3%, King Leopold was there in Congo. Germany, Bismarck has ended. Bismarck has ended already. France, Russia, Italy 2%, Netherlands 2.5%. Today, United States, all the other is peanuts. Belgium disappeared. Italy, well, we still here. Canada, France, 2.8%. So what does it mean? If you want equity, now you go to the United States, Wall Street. But in which moment are we now, today? That number, another one. We are in a moment where everybody has to reshape the industry to gain ESG, sustainability, change your machinery to gain sustainability, look at the car automotive, and digital. You need to increase your digital, artificial intelligence. I would like to have basic intelligence, but I look at artificial intelligence. The European Union, Mr. Draghi, Mr. Letta reconfirmed, talked about almost 800 billion euro per year of investment. Huge amount. So are we able to provide this money from our fiscal support from the Ministry of State of Finance in every state? No. If we want to be competitive in Europe, or in Kazakhstan, or in Kurdistan, wherever, you must have equity, which is missing. And where is equity? Almost in the United States. They drain the resources from all over the world, Latin America, Middle East, everywhere, and they created a market in Wall Street. You want equity? You almost go to Wall Street. Let's see if we can change this rule. Private debt. Normally, we have a look at public debt. We say Italy has a strong public debt. Belgium, where is Belgium? Almost the same. Germany, where is Germany? We have a lot of money to spend. But private debt is what the family has as debt. And Italy, Germany, they are well positioned. So it means that we can finance. We can easily finance Italy, Germany, private debt and households, very low. Netherlands, very high. So there are some countries in Europe which can easily provide the natural resource called saving rate to help the company, to help the banking sector, to help the corporation to reshape their mix of factors. But what do we have in Europe? In Europe, we do have more SMEs. Sometimes they are very small. In Germany, you have medium enterprises. In Italy, we have really micro enterprises. Same in Spain, Portugal, etc. So we do not have, except for France and Netherlands, we do not have a large number of big enterprises. We have small enterprises. Plus, we do not have high technology. We have old technology. Car is an old technology. United States has new technology. Andiamo avanti. Ancora. Financial markets. This is a comparison, Italy, France, Germany, Spain, UK, US. Anglo-Saxon, Europe. Market cap on GDP, an easy ratio. Italy is the lowest, 38. It means we do not have enough market cap compared to our GDP. Our stock exchange could be 2 or 3 times bigger. Same for Germany, same for Spain. Germany, a champion in the industrial world, but not in the financial world. France, something bigger, because France have a rule that says that pension funds must invest in local stock exchange. UK and US, the giants. So their economy is heavily financed by financial market. This means if you look at price earning, you all know what is a price earning, yeah? I think so. Marina.
Yes, they do.
Yes,
They
they do.
lie, they're lying.
I suppose that.
They always, they say they.
Let's first question at the exam will be price earning, yeah?
Price earning for sure.
So Italy as the lowest, look at US. It means that normally the flow of funds that goes into the financial market in the US provide better prices compared to their earnings. 10 times in Italy we have bank and let's say old industry. Germany, same old industry. UK, you find here Google, Apple, and all the others, new things. So the more resources you drain, you keep into the financial markets, the more the better it is the price earning. 20 years ago, if you wanted equity, you would have gone to stock market, being listed. Today, there is a competitor, which is private equity. Many of you will be working one day in private equity. Private equity is a club. I raise money from all these investors, and I provide money to him as a private equity. It means equity, not bond, not credit. But he will not be listed. One day, if it goes very well, we will list him on a stock exchange, or we will sell to someone else. It means there is a new competitor in financial markets that provides equity to entrepreneurs without going listed. And they are getting a stronger role. In Italy, we are quite new. This is the numbers, and it's getting more and more higher. But the number of deals that they run normally is manager that buy the company, buy out. So one day you might be a manager. You will say, I want to buy my own company where I work. I go to private equity number 1 and number 2. I ask to have a quotation and I try to buy out the company. Many of you will be working here. Yeah. And this is the saving rates in Europe. All are positive. All are positive. Means that Europeans are strong savers, and that's it. This is the path of our population. We're getting older. We have a large number of old people, small number of young people. You know the story already. This means we will have some problems in the pension system. Go ahead. Thank you. And this is the key. Pension funds. Pension funds have a role in private market, in financial markets. I work for 40 years. I give money to him, which is a pension fund manager. Very good stuff. So we get this money, and he must manage my money when I be old. Now the question is, where do they invest? Normally, in Italy, in Europe, they invest in government bonds. They buy the Bund, They buy the Italian government bond, the Spanish, the Belgian, etc., which means less risky. But they invest very little money in financial markets in equity. So that's why we have a lack of equity in Europe. Why? Because traditionally in Europe, we have a good pension from the states. Right? In Germany, in Italy, in Spain, we have a good pension from the states. So people didn't have the need to buy, to sustain, to subscribe a pension fund. Different in the United States and in the United Kingdom. They know that the pension from the state will be very low. They have to put money, to save money into a pension fund all life. And those pension funds in the United States, make an American accent. America, more money, more salary. Those pension funds in the United States, they invest more money in equity. So the big difference between Europe and the United States is the amount of money pension funds invest in the financial markets. And they are normally long-term investors. They do not trade daily. They have a long-term view because I will retire when I'll be 70. You too. Buy pension funds today. Don't wait. So some governments in Europe have decided to make some decisions. First, in the UK, in order to sustain financial markets, to provide more equity for the corporation in this moment where we need a restructuring of the corporation, etc., they decided to provide a little reform. They say if you open a saving account up to £5,000. £5,000 is nothing. It's 6,000, 7,000 euros. I think no more. And then you get an incentive. You will not be taxed if you get a plus value payments. But on the other way, Sweden has made a great reform. They say everybody must have a pension fund, plus the pension fund must invest a little percentage, around 5%, in equity in Sweden. This means that Swedish corporations have every day funds coming in the equity market, so they can take equity at lower cost of equity. You remember how to compute the cost of equity? Marina, they know how to compute the cost of equity.
They always say they don't, but they know.
Second question. So some governments are trying to change the landscape. So conclusion, where do we live? Europe. What do we need? Equity. We need an awful amount of equity. Where do they come from? We have the possibility to take from pension funds. Because we are old people, young people must buy a pension funds, and pension funds have a long-term view, they can invest in equity markets. If we increase a little of pension funds, we get enough flow of equity into the market. Then some states decided to lower taxation on pension funds. But if we want to make Europe equity again, it sounds a little Trump. If you want Europe to have equity again, we should move to make pension funds more active on the road. Finished.
So thank you very, very much, Commissioner Cornelli. Very, very interesting. It reminded me of something I said a number of years ago. I remember one of the criticisms, some of you may have read Marx. When I was young, everybody had to read at least a little bit about it. And so one of his points was that the laborers did not have the possibility to have the same returns as entrepreneurs because they did not hold capital. So that was his theory. And I remember that the counter argument, which I read, I think it must have been the Wall Street Journal, it must have been the newspaper anyway, was that actually, if you go and see who owns the US, the New York Stock Exchange, actually, even then, it was 60% pension funds. And if you look all over the world, an important component in the equity of companies comes from pension funds. And actually, some of the most active asset owners are pension funds. So this, separation between people who work and the possibility of returning, of having returns is actually in the capitalism has solved that via pension funds, which was exactly the point which Federico Cornelli so elegantly made before. Now, one of the ideas behind these seminars is to provide both a practitioner's view, which was so elegantly put by Commissioner Cornelli, and of course Luca Filippa, and what excellent academic research is investigating around these topics. So let me hand immediately the floor to Gonul Cholak. Did I say that correctly? He's going to talk to us about the timing of voluntary delisting and his presentation. Then we're going to have the discussion by Professor Lagasse. So Professor Cholak, and then Professor Lagasse, the floor is yours.
Okay.
Is there a clicker or something? No, yeah. Okay, I can stand here.
Up to you if you want.
Yeah. So
Come on.
I'm really happy to be here. My name is Gonul Cholak, and honestly, I did not expect this big audience. I was expecting such a academic oriented, and so much interest to it got me excited. Not probably as energetic as Federico was, but I will try to make it interesting to you, the academic side of the paper. So as soon as I figure out how to, yeah. Okay. I think this should. All right. Everybody can see it. Yes. All right. That's a success. Number one. So we were academically oriented, and when we were writing this paper, we were entirely trying to understand something that has not been modeled before. And we don't see the big picture as big as, let's say, commissioners or the leaders here of CONSOB can see. We don't see the big picture. What we see is more of an academic data, and we look for patterns in that academic data. So our goal was originally to understand why researchers such as René Stools, whom I will mention here a lot because I followed his research, and recently he gave a speech on why public equity shifting to private equity is bad for actually retired people in US. Yeah. But it's also apparently a bad development. So long story short, I will try to put it in the context in the beginning, what we were trying to do in the paper. And I'm very, by the way, let me say this, I'm very happy to see that academic research, which is usually, let me use the word geekish research, shows the interest of commissioners and CONSOB leaders. And I'm very happy to see this, the interest on the paper, but it is a contemporary topic, and we knew that it was a contemporary topic simply because of quotations like this. Michael Dell, let me say right away, Michael Dell, everybody knows it, Dell Computers. Many of us have it, including me. Dell has done an IPO in 1988, then decided to go private in 2013, didn't like it too much as private, came back and did an IPO in 2018. So it's like tried everything, get out of the public markets, come back, and then, so this was interesting for them, for us, pattern. Why are the corporations looking for something? And the reason he has written Wall Street Journal article, he basically says that he wants to think long-term, whatever long-term means for him. And he looks for other interesting aspects that he can develop. And there are some Financial Times articles on this issue. But let me introduce you to the concept called listing gap. Listing gap is simple description, technical description of, okay, in the past, it was popular to be in the stock markets. Now it's not. Calculate what happened to that popularity. And the popularity of being in the public market has been declining. This is not my paper. This is Ernest Stulz's paper, and they calculate this listing gap. In the United States, the peak of listing gap was around 2012 years or so. Okay? So about 10 years ago, this listing gap peaked. Around that time, it became least popular to be in the public markets in the United States. So the idea is, what contributed to this? Why is it public markets appear to be less attractive for the corporations? And that will be the goal of their paper, which is the paper by Caroli and Stulz. And they explain it by new listing, lack of new IPOs. Those of you academics who know me would know that I do research on IPOs. I love public markets. So I wanted to know why IPOs are done, what affects the IPOs. And one thing I showed in one of my past papers was to show that political uncertainty driven by gubernatorial elections in US, local governors. Whenever when there is an IPO, whenever there is an election, the number of IPOs decline, suggesting that firms take wait and see approach when there is uncertainty. So that wait and see approach is the key, and later on it will play a small role here in our paper as well. So listing gap, there are two reasons: decline in the number of IPOs, new lists, and high ratings of delistings. Which one is more important for the creation of listing gap? IPOs, decline of IPOs. So it's not only that the companies are leaving the exchanges, but there is not enough companies who want to do IPO. So there are many dimensions to it. I'm going to depict it in a second. Graphically, the blue one is United States here. The dotted one is non-US countries, and the dashed dot non-US developed countries. This includes Italy, of course, in this one. What you're going to see is the number of, again, this is not my paper. This is the paper that started this whole thing, listing gap, Ernest Stulz. What they show is that the popularity of public firms has peaked on the Western countries in around 2000. This dotted line is Italy. In US, the blue one is much worse. It peaked around 1997, and since then, number of public companies have been declining. Why is this a problem? So I had this discussion, is this a problem? Maybe it's a problem for CONSOB or Securities and Exchange Commission, but is there a problem for the society? And what it turns out that it appears to be a problem for the society for many reasons. First of all, private equity is less regulated, therefore they can do many things. And second, pension funds cannot invest in private equity. My pension fund, teachers' retirement fund in the United States, cannot invest in private equity. And therefore, I cannot gain of any profits that private equity companies are making with all the Silicon Valley companies. So therefore, for me, it's as a person who is looking forward to nice retirement, as we all at 70 or whatever age we are going to retire, we want to gain these kind of benefits. And if those benefits, the returns, are going into the private equity and there is no investment in private equity, then I miss out on that one. Again, this is not my paper. This is the paper related by Schlingemann and Stulz. Ernest Stulz, who is Swiss originally, but one of the greatest researchers, my hero, if I can say so, on this area. He basically shows in another paper that the economic activity driven by the public markets has been declining. So this is all the economic activity attributable to public markets, suggesting that economic activities are shifting from publicly regulated markets to unregulated markets. To some people, that's good, but so the researcher's job, like people like me, is to understand what is the good side of it and what is the bad side of it. And that's what we're trying to do in this. We shed small light in our paper. So let me try to explain what drives the listing gap. First, if the number of IPOs increase, there is more companies traded in the exchanges. So these are the exchanges. Therefore, cross listings are listings where Italian companies go and list in US. American companies come and list in Italian stock exchange for whatever reason they prefer that. So this is cross listing and IPOs. If we increase the IPOs, public markets grow. However, there is drainage out of the public markets. Number one, due to M&As, the companies are consolidating, mergers and acquisitions. So the economic activity doesn't disappear, it just gets consolidated, and we have bigger and bigger and bigger conglomerates, giant corporations now. Many public firms in US right now have a bigger market size than the GDP of 90% of the countries. NVIDIA, for example, right now has a very large market cap. So this is probably driven by consolidation and other factors. Another delisting reason is further failure to meet exchange requirements. And this is determined which companies fail to meet, presumably companies that are failing and weak. And these consult, for example, in Italy, decides who is failing to meet the exchange requirements, and they get kicked out of the exchanges for various failures. Delisting reason number 3 is liquidation, which think of it like bankruptcy. The one that we are focusing on in our paper is voluntary delistings, going private transactions, voluntarily leaving. This, for the listing gap, the going private transactions are relatively less important for the listing gap than the IPOs. My original research was IPOs. The journal started not publishing my paper because IPOs were not hot anymore. So I said, what is happening here? And then I tried to understand everything else that is going on, including exits from the market. I want to shed now bigger picture on the listing gap rather than focus only on this side. So that has been strategic decision from my side. If you're curious, I believe this is an Italian gentleman, D'Angelo and his wife started this whole literature on going private. They are in US in 1984 paper. And then later on, there was a delisting paper in Journal of Law Economics. So they are looking at it from the law side of it. So, and additional levels of delistings are going dark, deregistration, and going dark refers to companies that are moving from highly regulated exchanges to another exchange that is less regulated. That's referred to as going dark. So this is our paper. In our paper, we define voluntary delistings, voluntary side of it, as a decision to take the firm private, voluntary liquidation, or company's decision to list on it. Mergers are not part of voluntary delisting. We don't count it as a voluntary delisting decision. And here is what happens to the trend of voluntary delisting. You should focus on the red one. We intentionally put it red because red is alarming and it's not necessarily that we want it. So what you see around the world, 26 countries. Our sample is 26 countries, Italy included. But you should understand that voluntary delistings, at least in our sample, are relatively rare. 1 or 2 a year is normal for Italy, for example, voluntary side of it. There is other delistings. So what you see is in the developed nations, mostly 26 countries, the voluntary delistings are increasing. The trend is most visible in the red one rather than the blue one. Blue one is actually, sorry, voluntary and involuntary are increasing together, but in general, they are not following merger waves like in M&As. M&As can fluctuate as a wave, but voluntary and involuntary ones are not. So what did we try to do? We wanted to create a theoretical academic model that will try to explain why companies choose to go voluntarily to go private. Why? And we describe it with 2 main things: agency motives and economic motives. So let me borrow something from Federico's. Do you know Federico's book? Do you know what agency motives are?
Third question after some.
Yeah, it's in the exam. After the PE ratio. Agency, when I say agency motive, it's a fancy way of saying the CEOs behave selfishly. What does that mean? Many things go under the umbrella. So if this basically in this particular case, I did not invent it. Michael Jensen and many other people in Stools have done research. And Nobel Prize winners Holmstrom, Finnish researcher Holmstrom has done research on this. The idea is, when do CEOs tend to behave more selfishly and when they behave less? And the main reason why the existence of regulatory bodies like CONSOB is to balance this human nature of wanting more money profits for myself. We are all selfish. And so balancing this corporate governance side was the key. Therefore, we are asking a simple question. When delisting happens, is it because of selfish reasons? Entrepreneur has selfish motives to do it? Or is it because entrepreneur thinks of the shareholders and wants to do it for economic reasons, which is increased profit, increased productivity? So this is the balance between the two, economic reasons versus selfish reasons. And then we say economic motives can be shocked by macro shocks, such as anything that is macro, political uncertainty, regulatory burden, and other such things. I'm not going to bore you too much with the model, but I just want to mention that our model is based on IPO models that are written by Schleifer and Wolfenson, Stools, and Stools 2009. That's why majority of the things here are written in their regard. So agency problems we approximated with this VVN, the one that is red, and governments around the world, 26 countries, are creating regulations to prevent this selfish behavior by the CEOs. However you define selfish behavior, anything in general. So in context of the equity, we were discussing, in the context of equity, selfish behavior by the management or the entrepreneur happens in the following way. Entrepreneur is not 100% owner of the company, but controls sufficiently large number of shares, and therefore uses the profits of the company for example, to buy himself or herself a jet that belongs to the company, but a CEO consumes them. So these kind of perks are considered detrimental to the shareholder wealth, and that's why regulatory agencies want to reduce them. So there is no direct measure of this. It's very difficult to monitor, and therefore they are approximated by various costs. So again, regulators everywhere around the country impose a penalty. Currently, the regulatory system works as a deterrent mechanism. You should not, quote unquote, steal anything from your own company. There is no way for us to prevent you as a CEO, but if we catch you as a regulatory authority, we'll penalize you with a degree severity BN. And so therefore, it's a deterrent mechanism. Every country determines how harsh this BN is. And currently in the markets, given that there are a lot of delistings, claim is that this BN is too harsh in the Western countries. And you should let entrepreneurial spirits develop. I think that's the one of the explanations that is being claimed. So in our model, basically, we are trying to, on the left-hand side, I put few Greek letters here to look smart. So on the left-hand side, we have the ratio between the amount of agency appropriation by the entrepreneur divided by the ownership of the entrepreneur. The higher the ownership of the entrepreneur, the less likely the entrepreneur will steal from himself or herself. Right-hand side is the economic benefit. When the company goes private, maybe there is some economic activities the corporations will do better because they are less, presumably because they want to prevent information going to their competitors. Left-hand side represents agency, right-hand side represents economic motives. And then we claim that agency motives are important determinant of the listings. In other words, entrepreneur decides, remember what happens. Entrepreneur can expropriate from minority shareholders only when the company is public. Given the entrepreneur decided to go private, entrepreneur gives up that hidden right to expropriate from minority shareholders. And economic motives, which basically means when the company is private, the entrepreneur can do something better that cannot do when it's public, economically. And finally, we claim that macroeconomic shocks, such as political uncertainty and aggregate regulatory environment everywhere. Think of ESG, for example. Think of other regulatory issues, are essentially making corporations tired of regulations. So what is our sample? We manually collected this sample. It was hard, but that's why it's published in a good journal. We spent 30 years, between 1990 till 2020, and we exclude financial insurance firms. And of course, we read the news article about every delisting, let's say in Italy. If we find an article in English, we determine whether this is delisting happened because of M&A or bankruptcy. If it's not M&A or bankruptcy, it must be voluntary. So we have to read the article to determine that. So our methodology was very diligent. I'm not gonna bore you too much, but it's a large sample. It's 5,372 firms that we manually checked all the news articles about them. Surprisingly, we have fewer delistings. I will show you the sample, a little bit more interesting actually. Here is how the voluntary involuntary looks like. I presented this. And as a result, here is what we are finding, that majority of the delistings are actually in Europe and UK. We already discussed here by presenters that majority of equity in the world is in United States. So you expect more delistings in United States, voluntary ones. But it appears like voluntary ones are more common in UK and European countries. And the question is why? This is something interesting, at least to me. UK in particular. So let's say Italy is different, but UK and United States are speaking the same language. They have Anglo-Saxon system. So why is UK have more voluntary delistings than United States? It's surprising to me. So we gathered the numbers, and our model is more accurate, 97% accurate to predict behavior in Asia than behavior in Europe. We did some simulations here to show what determines voluntary delistings. By far, voluntary delistings decision of the entrepreneur is most sensitive to his or her own ownership of its own company. Entrepreneurs that have high ownership of its own company, have a guess, would it increase or decrease the likelihood of delisting? Increase it simply because it's much easier, less costly for the entrepreneur to acquire the remaining shares. So ownership, therefore, and one explanation why in Europe and UK it may be easier to do voluntary delistings is because entrepreneurs, especially in countries, let's say like Italy and other European countries, Nordic countries as well, the entrepreneurs hold a large ownership share of their companies. They keep it. So family ownership is very widespread in Europe compared to the United States. But in UK, it's surprise. So UK, we cannot explain. On the other hand, the graph here is flat, suggesting that dividends and listing exchange fees. So this may be of interest to the consub here. Listing exchange fees are almost not important for the corporation. For the listing purposes. They may use it as an excuse, but it doesn't appear to be that important here. Okay, so then we try to test this, and we use some empirical testing. In particular, we use sub-hazard rate of firm. We will have managerial variables representing managerial agency. This is countrywide, BN, the strictness of regulation. Alpha is the ownership, B is the dividend rate, L is the listing costs. So these are the fees that, let's say, exchanges are charging. It could also be auditor costs. And this is the growth rate, and this is the volatility of the revenues of the firm. Obviously, firms that have a lot of volatility in their businesses may choose to go private because markets punish them quite a bit. And if you do comparison, you find that in the delisting sample, voluntary delisting sample, this one here, the difference between voluntary delisting and involuntary delisting is highly significant. These are 6 parameters that we found important. Our paper is the first one to suggest that you should look at these parameters when you are determining voluntary delisting. And they are significant across voluntary and involuntary sample. Then we run some regressions. And basically, we find that by far the most important variable that determines the delisting outcome is the ownership. Yeah, this is the ownership. And then the second most important one is the regulatory strictness of the country. So regulations appear to be second most important one. Whatever cultural ownership that exists in the countries appears to be number one reason, alpha, ownership, basically. So again, if there is in certain countries, there is a lot of ownership by entrepreneur, that facilitates the delistings quite a bit. Then we looked into whether externally, politicians, let's say, let me be more blunt, do the politicians cause this delistings? Can the politicians bickering and fighting on TV create policy uncertainty? It appears there is a small role to play. In other words, in recent years, political uncertainty has been rising everywhere in the world, not maybe only here in Europe, but everywhere around the world. Political uncertainty, meaning policies are changing. Let's say in the United States right now with the new elections, there is a huge debate about ESG policy. So this doesn't mean that one side is right, the other is wrong. It just means corporations do not know which policies to follow. This is called policy uncertainty. And policy uncertainty in recent years explains this trend downwards for public corporations. And I'll show you in the next slide. Notice the arrow downwards, number of public corporations, and political uncertainty has been rising around the world. This is the political uncertainty. And we have done quick regression on this. It turns out political uncertainty and regulatory burden appear to be important. Regulatory burden, I will admit here, and given that we are in a policy environment, policymakers environment, our proxy for political uncertainty is very good, but our proxy for regulatory uncertainty is not very good. I admit it, even though it's significant, even though it's part of my paper. Suggestion, I want to find a better regulatory burden measures around the world. I don't have it right now. I am done.
Thank you very much.
Yes.
Wow.
So my suggestion would be that we have the discussion by Professor Lagasse, and then we're going to have a quick Q&A. Professor Lagasse, you have 7 minutes because we have some Q&A that practitioner Q&A. So
Yeah. Okay, so thank you very much for letting me discuss this paper, which I found to be not only interesting, but also helpful for addressing this key issue. And that is not only about financial structure or corporate governance, it is also about corporate stories and corporate decisions, like deciding to delist from a stock exchange. And I think that is why it has been presented in a conference where regulators meet academics. So that was interesting. And I'm not going to go through all the paper as we commonly do in the academic conferences, but I'm trying to focus on some specific aspects that I found really relevant. And then I try to propose some new research avenues for future research on this. So first of all, the theoretical model that you used was extremely comprehensive, and that was interesting because you were able to disentangle the agency from the economic avenues of your model and your framework. Then the data set was really rich because you have 26 countries for 3 decades. So it's something that is really difficult to find in this kind of data. So that was a key point, a key strength of your article. You were able to separate the agency motive from economic drivers, but you also included the institutional factors to interact to your variables with your variables. So it was interesting to see also the results in this model. That is a timely topic, of course, as we know, in a moment in which the number of firms is declining worldwide. Here we have the comparison between the new IPOs and the delistings that occurred in Italy in the last years from 95 to 2024. And as we can see from this graph, we have a cycle nature of these two trends. And this is something that, of course, not only in Italy, of course, but also worldwide. So it is a crucial aspect that where you decided to investigate indeed. So as concerns your results, you found that insider ownership increases the likelihood of the listing, and that is your main result. But I would suggest also to investigate more on the different types of ownership that can be related to your corporates. You also found that lower growth rates push firms to opt for private control, and that, of course, business risk accelerates the listing decisions. Then policy uncertainty acts as a powerful external catalyst. So you have both the views, external and internal views, and all the different factors that are related to these views can be used to also craft policies to help companies in raising more capital, basically, and to make up the strength of the national financial markets. So as concerns the suggestions that I'm trying to propose to you, let me start from the geek ones, as you said. So on the methodology side, I would suggest you to use some advanced survival models that in this way will help you to also model the survival shape of your corporations, by also implementing some machine learning techniques, and to maybe insist more on the granularity of ownership data. You can also get some policy sentiment analysis to understand whether the uncertainty impacts that you linked to the decision to the list may be also somewhat driven by the sentiment in the financial markets. Another interesting aspect that I found mentioned in the paper is about relisting. So the situation in which the company decides to delist from a market and then to list again in another financial market. I think that this should be investigated more, because it's like when you decide not to bake a cake, because mainly for two reasons. One is because if you sum the cost of the single ingredients of your cake, maybe they would be higher than the cost of a ready-made cake. And you can think of it as a regulatory burden cost. And the other reason may be because you don't want to waste time to bake your cake. And that may be related to the efforts that you have to put in reporting issues and in regulation regarding ESG reporting and so on. So what do? You decide to buy your cake, and you go to a bakery and you take a ready-made cake, and that is about mainly relisting. So you go in another market that maybe can offer you more opportunities because of lower costs and because of probably lower taxation. So another aspect in which you can investigate is the taxation about industry-specific aspects. In order to bridge this gap between the regulations among all the different countries, so this kind of regulatory competition, of course, policymakers have a lot to do in this case. And I think that the Capital Markets Union can help in bridging the differences between all the regulation in the market. I also had a slide on the trend of the market capitalization on GDP, but the giants before me already told you about this. I only want to add something about Italy. We have that is actually, unfortunately, the last updated information that I had on market capitalization in Italy and the ratio on nominal GDP. What this slide is telling you is that we have an undersized financial market in respect to the real value of our economy. So we have a lot of areas in which the regulation can help, and trying to foster the growth of financial market in Italy. What I wanted to add, since we are here together with regulators, with policymakers, is that this is not only an academic exercise to put the variables together, but indeed is to help the stories of real corporates and to foster still the strengths of a financial market in a country. So thank you very much for letting me discuss this paper, and thank you for your attention.
We have a few comments, and I'm going to ask Mr. Conelli to start, but I also have a few comments. So I'm reserving myself until spot as well.
So thank you, Professor, for this extraordinary presentation. Teşekkür ederim. Çok güzel. Çok güzel. Thank you, Chair. I was thinking in Turkish, and one question. In my mind, the relevant decrease of listings depends on the relevant increase in private equity. The relevant increase in private equity depends on the fact that this industry has grown, but on the extraordinary low level of interest rates. I am a private equity. I can borrow money at very low interest rates. I go to Mr. Filippa, which is an entrepreneur, and I tell him, why do you go public in the stock exchange? You have a long list of rules, and you have a watchdog that look at you. I provide you almost the same capital. I am patient, blah, 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 and you are not under the same regulatory burden. As long as the low level of interest rates remain in the euro curve or in the dollar curve, we will see that private equity win against stock market. But we miss one issue in the regulation. If I were a pension a worker that has a pension funds, I would like my pension funds to have only listed investment, because listed investment provide me every day a price, and I am more safe because there is a set of regulation. In Europe, many pension funds, as I told, they invest on government bonds, very good, they have price every day, but they invest in private equity more than in stock exchange. It means that in these days, also the problem arrive in pension funds because they have less information on the real value of the pension that they might get. So my suggestion would be to see if the supply of cheap money to the private equity is another factor, which I suppose to be the shepherd level.
So, should I answer or how
Can I just
Yeah.
chip in a second? I have two very small comments regarding the regulatory burden. The two avenues I would pursue are, on the one hand, the fact that in Europe, we have cases of listing which remains in one country, but companies which change their registered office in other European countries in order to benefit from less binding regulations, which is a point that Luca Filippo and I we exchanged a text, so I'm not going to take credit by myself, but I was going to say it. And the other thing that I would look at, which I think distinguishes the US from Europe, is the fact that in Europe, we're very careful in takeover laws. So we like it to be very, very fair to everyone, which basically means that you cannot pay a premium for control. So I think that if you check in your sample, you're probably going to have companies which decide to delist in order to be able to sell, and in order for majority owners to be able to sell at a higher price. So that's another thing, if I have that wonderful sample, I will do that. And, but now, please do.
Well, thank you for the excellent questions, and thank you for the discussion. So one overall benefit from all this is I got so many good ideas to do with this sample that we have, and thank you to everyone involved. So let me go in order of the questions. First one is the interest rate. You may find it useful to know that, right? That's actually excellent suggestion, excellent comment. Right now, we are trying to determine whether the agency problems of debt, which happens when the corporation takes its equity, entrepreneur, let's say the remaining ownership that doesn't belong to the entrepreneur, and they substitute it with debt, borrow cheap money. Because in order for me to take my company private, I need to find some debt financing, which we call leverage buyout, to buy that equity. So what we are going to look next, and that's what we already started working on, is what happens to debt when the debt amount company has, and maybe external factors such as low interest rates that affect the debt borrowing capacity of the firm. What would happen? So to answer your question in a simple way, it's absolutely very valid, and I think that in our current paper, we don't have anything with interest rates, but I think it definitely affects the effectiveness of private equity firms. So I know the director here doesn't control the interest rates. Somebody else does. So the interest rates, whoever was controlling it though, was probably helping the private equity. And so that's one explanation for it, and probably we will have to look at it, another macro shock, but we are working on the debt side on it, and we'll see what we get. Of course, we have to model and everything. And
So-
thank you for the question. Yeah, quickly.
I think, shall we discuss this over dinner?
Yes,
So that I can move on, we can move on to the second paper, because I'm mindful of the fact that we're running late. So I would like to hand over to Victoria Bessel from the Technical University of Munich and Auxerre. She's going to present her paper on the EU prospectus regulation and its impact on SME listings. And the discussant will be Valerio Novembre from ESMA. So thank you very much.
This one? Yeah. What's the shortcut for looking at this?
Das
I don't
kann
know.
ich nicht lesen.
Yeah.
Kann ich nicht. Es langsam. Warte, wo?
Right, perfect, thank you.
Okay, cool. Then let me also stand up. Yeah, so it was really interesting listening to Professor Tumak, also hearing that you're passionate about IPOs. I think IPOs are still a pretty niche area of research, unfortunately. And maybe to motivate this for all of you still in your finance master's degree. I think there's still a lot of research to be done on the topic of IPOs. So maybe if there's something you're looking for, then take a look at IPOs. I think there's a lot still to be done. Yeah, and maybe on a personal note. So I was also a finance student not so long ago. And like it was previously said, probably many of you will end up in private equity or maybe industry even. But maybe there are also some of you who don't yet know where the path will lead. That was kind of similar for me. So then I decided to do my PhD, where I ended up working on the topic of European IPOs. And that's kind of when everything fell into place for me. And I also didn't then follow with the academic career, but I recently left to join an economics consultancy. So that might also be something that's interesting for some of you. Right, so this paper is about the prospectus regulation and its impact on SME listings. So this paper was published half a year ago, and we used data until about mid-2022. And of course, the prospectus regulation in itself, and I'll go a bit into detail about what that actually does, has been overturned by a newer regulation called the Listings Act. So I will also go into what that might mean going forward, what we can maybe derive from our paper for the efficacy of the Listing Act, and other important areas going forward. All right. Okay, so don't worry, this is a super long paper. I'll start off by briefly motivating. I'll give you an overview of the reform, which is actually a big contribution of this paper because European equity markets are special. They are very unlike the US. So I hope to give you an understanding of that. We address four main aspects of the regulation that I will briefly go into, and then I'll try and give you an outlook on what this could mean for the Listings Act. Okay, so the graph here basically shows that over time, while GDP has been going up, the number of listed firms has been going down. And this is a well-established trend. So academics are very well aware of this and regulators are very well aware of this, but yet academics can't quite 100% explain why is this happening. Like there are some theories floating around, but I wouldn't say that this is necessarily solved. And at the same time, regulators are also struggling to kind of overturn this trend. And so there's a hypothesis called the regulatory overreach hypothesis, which basically views regulatory complexity as the reason for the decline of listings. And I can tell you upfront that in the academic literature, this hypothesis has largely been found to be inconsistent. Nevertheless, we still examine it in the context of the prospectus regulation. And so very briefly, when a firm lists, it has to compile this super long detailed document called the prospectus. And that, of course, involves direct costs in form of fees that are being paid to advisors and underwriters. But there are also indirect costs in terms of disclosure of proprietary information. So think about maybe a biotech firm for which it might be worth to disclose information about patents and so on. And of course, all of these costs are disproportionately higher for smaller firms, so for SMEs. Right, and so the regulators noticed that, hey, maybe this prospectus, the document is too much of a burden for SMEs. And so in 2019, the European Commission enforced the prospectus regulation, which introduced the EU growth prospectus that you can think of as a prospectus light for SMEs. And there was a similar reform in the US, and not quite the same, but there was the Jobs Act. And that's kind of comparable. Right, so in this paper, we want to analyze whether the EU growth prospectus was effective at achieving its goals. And we do that along several dimensions. So first, we want to understand who actually uses the EGP. And that's not straightforward because within the way that this regulation was designed, firms have some leeway in choosing the document that they go with. Then we want to see how does the EGP differ practically. So again, a prospectus is just the minimum requirement. And in case there are frictions involved, then there's nothing stopping firms from potentially over-disclosing to kind of circumvent these frictions. And so it could well be that even though on the legal side, the EGP requires less disclosure, firms aren't really making use of that. Then we also look at whether listings costs were in fact lowered and if the reform achieved its goal of boosting SME IPO activity. And in case I run out of time, let me give you an overview of the results. So we find that in terms of who uses the EGP, it's kind of good news. So SMEs are more likely to pick this document. However, there was a bit of friction involved because as the IPO became larger, the likelihood of using the EGP declined and firms would rather go with the full prospectus voluntarily. Then in terms of practical difference, we show that the document is less complex without jeopardizing investor protection, and I go into detail how we determined that. We do not find evidence that the listings costs are lowered for the EGP, specifically the fixed listing component does not appear to be lower. And you can probably already guess this, given that the reform was overturned. We also think that it's unlikely that this reform increased SME IPO activity. Right, so in order to understand more of what we do, you have to understand the reform. And to understand the reform, you have to understand how the markets are set up. And probably this is a bit, obvious for the regulators sitting here. But for academics, I can tell you it's very much not. And so the framework that we come up with, we hope at least, will encourage more research in future into European equity markets. So basically, European equity markets have two important dimensions that need to be distinguished. First off, you need to look at who is the offer addressed to? And here we have the classic IPO, so initial public offering addressed to the general public, but there are also private placements. On a very basic level, there are more dimensions, but this is a simplified version of the framework. And private placements are only addressed to qualified investors. Second dimension is which market are you offering your shares on? So there are regulated markets where EU law applies directly. So these are governed by public law. And then, and this is the specificity of the EU, we have multilateral trading facilities or MTFs, and those are actually governed by private law. So the exchange itself will come up with which document needs to be drawn up for specific listings, and not all aspects of public law apply here, only some do. What does this mean in terms of which document needs to be drawn up? Well, that depends on which quadrant you're on. So firms always need to issue a prospectus if they are listing on a regulated market, no matter how they are listing. And in principle, the prospectus requirement is also triggered in case of an initial public offering. So for a private placement on an MTF, the prospectus requirement is not triggered. So that would be this quadrant here. And firms can use an admission document that's not approved by the National Financial Markets Authority. And the content would be set by the exchange, and usually those are shorter or like require less disclosure. Now for an IPO and an MTF, it depends. So depending on how many proceeds are being raised by the firm, they can also use the admission document, and only beyond that do they have to draw up the prospectus that needs to be approved and so on. Right, so 4 very basic quadrants here. What did the reform do? Direction. So the reform only really had an effect on this quadrant up here. So if a firm is conducting an IPO on an MTF and it would not be eligible for using the admission documents, so proceeds are too high, but it fulfills a couple of eligibility criteria, then it's eligible to use the EU growth prospectus. But just from looking at like the setup here, you can tell that the scope of the reform is a little bit narrow. because even when a firm is eligible to use the EU growth prospectus, they can still choose to voluntarily use the full prospectus. And if it's exempt from having to issue the prospectus, well, then there's the admission document, which requires less disclosure than the EU growth prospectus anyway. And so just as a very brief idea of how the content compares, the EU growth prospectus would require less disclosure than the full prospectus, but more than the admission document. Okay, brief word on our data. So just like the speaker before me, IPO research takes a lot of hand collecting data painstakingly, especially if you do work on European IPOs, because the databases that are normally available don't have great coverage of these MTFs, so the multilateral trading facilities that I told you about. So this involved a massive data collection effort. We collected every single prospectus and admission document and growth prospectus from company websites and national financial markets authorities and so on. We do a lot of textual work with that, and all IPO data that we collect is taken directly from the prospectuses. Right, so let me start by addressing who uses the EU growth prospectus. And so remember that within the quadrant of IPOs conducted on MTFs, you can be exempt from having to issue the prospectus, or you are not exempt, so you would have to issue the prospectus. So for non-exempt offers, so those that cannot use the admission document, it looks like the EU growth prospectus seems to have pretty much crowded out the full prospectus with some hesitancy. So a third of issues still use the full prospectus, even though they would be eligible to use the growth prospectus. And we find that this seems to be driven by the amount of proceeds raised. So the higher the amount that's being raised at the IPO, the more likely it is that the firm will go for the full prospectus instead of the EU growth prospectus. And so that tells us that there seems to be some hesitancy in using this document, or some sort of friction. On the exempt side, not surprisingly, the green is the admission document. So if a firm is exempt, then only very rarely will it opt into going for the EU growth prospectus or the full prospectus when it doesn't have to, and this isn't surprising. But it also means that as a tool of like increasing SME listings activity, when most of them are eligible for the admission document anyway, unlikely to boost IPOs. So we do pretty comprehensive textual analysis of the prospectuses that we collect. And this is also non-trivial for a couple of reasons. So first off, while the content of the prospectus is kind of standardized, like the way that firms present this isn't. So we had all kinds of things in there, scanned pages, differences in formatting. And if you compare that to the prospectuses that you see in the US, those are super standardized, while here there's a lot of variance between countries, even in the same country, between exchange segments. And the other problem is that, of course, we have a couple of different languages in the EU, and different languages have different levels of verboseness, right? And so we translated all these documents to try and make them comparable. I mean, prior studies tried looking at page counts or word counts, but we argued that without translation, that's not really a fair comparison. And so we tried to make the comparison fair. Lengthwise, these are plots showing how the length of the different document types differs. This is the growth prospectus, the full prospectus, and the admission document. And so this is looking pretty good for the EU growth prospectus because it seems to require a bit more disclosure than the admission document, but less than the full prospectus. So that looks like, in that case, the reform delivered. Then we look at how similar is the EU growth prospectus to the full prospectus versus to the admission document. And we find that it's more similar to the full prospectus than to an admission document. And we interpret this to mean that complexity has been reduced while investor protection has been maintained. So looking at the costs associated with this document. So here we do a decomposition into fixed and variable costs. And we basically find that in terms of fixed costs, there's no difference between the EU growth prospectus and the full prospectus. And any differences in variable costs, as you can see, not really a difference between those two lines. is not economically meaningful. And so it doesn't seem to have been the case that this document cut the direct cost of listing for SMEs. So finally, we look at SME listings activity, and here there's a bit of a challenge econometrically. So here you can see a plot over different half years of listings by non-SMEs, that's the lower pink line, and SMEs, that's the green line. So the reform came in here. And look, there seems to be a peak in SMEs a little after the reform came in. So might that be due to the reform? Well, at a first glance, kind of, even though we would expect the effect to be more immediate. However, there's a problem because what does this period coincide with? The COVID listings boom. Exactly. So there was a huge spike in listings triggered by the COVID pandemic. And this is unfortunately what this coincides with. And so to kind of disentangle whether what we're seeing can be attributed to the prospectus regulation or not, we add another dimension of difference by also comparing SMEs and non-SMEs in the US. And once we introduce that comparison, then we find that the reform did not boost SME listings in the EU, or it's at least unlikely to have. Okay, now let me get to my conclusion and some implications for the Listing Act. Right, so this is what I already summarized. I think this is the interesting part. So in the meantime, the Listings Act has been, I think, approved and it's set to be enforced next year. What does the Listings Act do? So remember the 4 quadrants. The EU growth prospectus is now replacing the full prospectus. So that kind of retroactively affirms our finding that investor protection really doesn't seem to have been compromised that much. Apparently the regulator agrees. And the EU growth prospectus itself is being replaced by a new EU growth issuance document. And I believe that this document is mandatory. So if a firm qualifies for using it, then it has to use it. But again, given that it still competes with the admission document, like my personal inclination would be that it's unlikely for this to boost SME IPO activity. And I mean, from my point of view, that could be attributed to the fact that if you think about the costs associated with the prospectus, those are sunk costs, right? And then the costs that you inquire by listing, both directly, so in terms of ongoing advisor fees, and indirectly in terms of ongoing disclosure costs, I think those are probably much more relevant than the costs incurred at listing. So then maybe let me give some more points for discussion, also maybe for dinner later. Deburdening may not be the answer to the dearth of SME listings, and this is also what the academic literature has found. So like I said, the regulatory overreach hypothesis, not really a lot of evidence showing that this is consistent. I think it would be interesting to maybe examine SME-specific programs that some exchanges have going on. So there's Elite at Euronext Milan. I think it would be really great to have more data on that available and do more analysis. Then UK is setting up a new market called Pisces, which is basically a market for trading shares of private companies. So that could be interesting. And then I call this like the cultural aspect, for lack of a better word. But actually what I found in the paper is that there's one country that really stands out in terms of listings, and that's Sweden. And a couple of days ago, the Financial Times also published an article about that everyone keeps on going to Sweden and trying to understand, hey, what is Sweden doing differently? And the interesting thing is that not only does Sweden have way more listings, but they're really teeny tiny listings. And so I don't know if there might be some herd behavior going on. But yeah, it would be great to understand why are there so many small IPOs in Sweden, or like IPOs in general? Could that be driven by cultural factors? And then I also think it's interesting that the type of how firms list, that's totally clustered by country. So private placements, super dominant in Norway and in Italy, while in Sweden, for example, companies go for IPOs. So I think there's still more work to be done to try and understand that. Yeah, and then for financial markets authorities, well, I put a quote up there from Christine Lagarde, who basically called for a Kantian shift. So she recognizes that even though we have ESMA, so like a European Financial Markets Authority, that's not really a singular authority. So depending on where you list and on which market you list, even though Euronext, for example, spans so many countries, depending on which country you list on, which country the company is from, different listing regulations apply. And so the market is still so very, very fragmented. And I think there's a discussion to be had about which kind of competencies would make more sense at the level of ESMA. Hope I'm not burning your house down here, but yeah, I think that's an interesting discussion to be had. So thank you. Yeah, that brings me to the end. So thank you very much.
Thank you very much, Victoria. Your final quote basically on ESMA is the perfect lead-in for Valerio November, who's going to discuss your paper. We are running a little bit late, and also I see that Commissioner Corneli has notes.
Long list.
So, you need to summarize your discussion in 7 minutes,
Very
which, keeps you, provides you with a bit of helpful stress.
No problem. So I'll do it very quick. So first of all, thanks a lot, Marina, for inviting me today, and thanks to all the organizers for hosting me. And of course, views are mine. That's Savastandir. So I will try to, in 7 minutes, then to go through the research question quickly on the methodology and make some suggestion or just ideas for future research, let's say. So first of all, I mean, the research question I think is extremely relevant. I mean, it's the holy grail. Prospectus was, I think, at the beginning of the CMU story, the holy grail of CMU. Like, oh, it's a problem about all the problems are prospectus related. So we need to fix it. If you remember, in 2014, that was 15. Let's say that was the emphasis, and of course, based on the idea that the demand of capital in Europe is hampered by this extremely costly environment. I will not get into, why the data about, the difference between Europe, US on market capitalization and so on, I think are just very sad. So I will avoid that. But generally speaking, there has been a lot of emphasis in saying we need to fix it. Europe needs to get up to the speed of the US in terms of market structure. How do we do it? And one big thing at the beginning of this journey, but I think now it's much less, and this is consistent with the paper, is the idea of the bargaining effect, reducing listing costs in any way possible, and doing it without reducing investor protection, of course. So this was, this big trade-off that we discussed a long time ago, and let's see, we know how it went. And I think the paper is consistent that we found that, yes, we have tried to do that to some extent, but the results have been probably not astonishing, which may mean we need more ambition, or may mean what the paper argues, that this doesn't have such a big impact anyways, right? So this is the framework. Research questions, you went through them, so I will skip in the interest of time, but clearly it's 4 papers in one, essentially, one can say, because it's 4 relatively important research questions. And when it comes to the methodology, I found it very interesting, the setting. I think it's a very nice setting, and also the research design. I will not get into details because I understand this is not purely an academic discussion, but more sort of trying to bring it down to earth. But of course, also in terms of the techniques you used for the different research questions that you had, I tended to agree. And also I think you were sort of lucky in a sense, because you could rely on a lot of similar US literature, but not European. Plus on question 4, you could use this the methodology triple difference estimator, which I found very, very efficient in tackling the issues. But I will not spend time on that. And you also recognize there is a limitation by design in fact that, somehow there is a limited scope due to the possibility of listing on SME growth market via the admission document, right? So you have another way to go to get the same results, and this limits to some extent the results. But let's go directly to the results then. So first question you ask is which firm characteristics have a positive impact on the use of your growth prospectus. And basically, the answer is, well, small SMEs basically use it as long as they raise limited amounts. That's the short story. And that's, I think, an interesting result, meaning that when they get a bit bigger, probably they prefer to use the prospectus. I wonder whether this is related to cover their legal responsibilities, or it's because most of the fixed costs are already sort of fulfilled, and therefore, maybe the remaining variable additional costs are at the margin, at minimum. That may be an explanation to discuss. The second question is whether what is the impact of the reform on the international informational content of the prospectuses. And here you argue that indeed the UGP has been effective in reducing disclosure, so it has been a debardening. I have some observation for later, but one thing I found interesting is you mentioned the corporate governance section is even shorter than the admission document, which reminds me of the discussion at ESMA in 2016-17 when we had the delegation. And indeed, that was the only section that everyone was agreeing to take it out, like all the rest, like we need to keep it anyway. So somehow it reflects a little bit the discussion at policy level. Point 3, you, in terms of the usage of this new IPO channel to lower direct listing cost, you say it doesn't do it, let's say at least for fixed cost. And when it comes to raising SMEs listing, which is the big elephant in the room, probably not, right? So some ideas in terms, just comments, I think, really, in order to discuss together a few of the points you argue for. So the first one, I think it's a very important conclusion you make, is the EU growth prospectus effectively reduce disclosure. Here, I think it's certainly very true based on the information you looked at, but I would put in the framework, in the equation, let's say also two things. One is to look at the required information in the first place, so the schedules, the level 2 schedules by ESMA indeed, because somehow, for instance, for corporate governance, that explains why it's shorter. It's simply because it was cut down, let's say, at the policy level. And secondly, I know it's a huge elephant in the room, but the regulation versus supervision element. So we all know that, unfortunately, what is on paper, the law on the books is not the law in action, and supervision matters. And so the country by country, which you hint to in your last slide, looking at country by country, I know you look for fixed effects for countries, but really opening the black box of how countries behave across Europe, I think would really may tell something interesting. Second point, you argue that in line with the US literature, that there is limited impact of the regulation. And I would say, here, maybe one point to keep in mind is that the UGP may have been designed in a little bit too shy manner by ESMA and the Commission. I mean, to be, we need to be realistic. Was it too shy? And here again, I would look a little bit if there are differences at country level in terms of the impact, because again, may be surprising. And final point, whether, I know that this came later, of course, but the recovery prospectus first, and now with the listing act, looks like a bigger effort in terms of the bardenization. Then I'm not sure whether you are right, probably that they would use the offer document anyways, so that could be a good answer. But I think if you want to repeat your exercise, because you have done so much work with these regulatory novelties, you may be more lucky this time, because I think the gap in terms of burden reduction is wider now. It's more ambitious, much more ambitious. And then fourth point, you say something that I think for a policymaker is huge. Prospectuses can be simplified without jeopardizing investor protection. And here, I think, I'm sorry, I think this is something one needs to be very careful. I may agree personally, but I think nonetheless, it needs to be looked at more in detail. And here I would suggest to extend the analysis that you do using natural language processing, which is very interesting, by looking, for example, at the real length of documents, incorporation by reference, because you can also measure how long are the documents that are incorporated by reference. To look at text duplications in the document to see if they just, boilerplate language, to extend the analysis to linguistic complexity, and to cover again cross-country variation more explicitly. Here, I suggest you look at an article by Adrian Asmalag, a colleague at ESMA, published in 2022, which is very interesting in that sense. So to conclude, and I think Marina, I'm more or less, 30 seconds. Recommendations from my side would be to, first of all, great paper, very interesting. It addresses one of the holy grails or the center of the discussion, especially at the beginning of CMU, but possibly good idea to further extend the text analysis via natural language processing, put supervision at the center because it's very important, and probably by looking at country by country, you can really get much more information than just controlling for fixed effects. And as a next steps, if possible, really try to see if the listing act with the EU growth issuance document and even possibly the recovery prospectus could have a slightly different impact on your model. With that, I conclude, and congratulations again on the great job. So.
So let's turn to the practitioners discussion.
Many thanks. I wonder if you have presented this to DG FISMA in Basel, to Sean Berrigan. This would be a great COVID. I think during COVID there was the credit crunch, and we solved the credit crunch by means of a temporary framework with DG competition. It took some time for all the biotech companies were listed to get some resources there. Sweden, there is a role of pension funds. Pension funds had a law that forced them to invest, if I'm not wrong, 5% of the resources inside the stock market of Sweden. So there is a continuous flow. This is the reason why I push on the role of pension funds. But the real issue is, I think the prospectus is really not so important for the listing. I see three roles. The first is non-bank financial sector is not regulated. I sit in the European Systemic Risk Board, and we are now asking the Commission to provide a first level of regulation for non-bank financial. Second, low interest rates, we have already discussed, they have a favorable interest rates for private equity. Third is we are missing the pension fund authorities. Pension funds authorities should require pension funds to invest their money in stock listed because they have transparency, pricing, rules, etc. While if they invest in non-bank financial private equity, there is only an esteem of the potential value of these investments. But we prefer stock markets. So you're more liquid, blah blah blah, and the reasonable good price formation. That's all.
So thank you very much. 1 second, I have to conclude, and I cannot conclude without thanking, first of all, Francesco Fancello and Federico Pico, who worked very, very hard at organizing this, Paola De Rio. These are all members of the scientific committee. Elisabetta Cafiero, who is not here, Professor Panetti, who just left, Maria Antonietta Scopelliti, and I think I mentioned everybody who was not present today because some of us have the double hat. So thank you very, very much. And also I have found a new example from one of the great sentences that we have in scientific research, which is correlation does not mean causation. I am convinced that the increase in listings has nothing to do with the EU prospectus and COVID and really the new listing, the EU growth prospectus have no correlation. They have correlation but no causation. So it's going to be a great example that I need to be using again because I was trying to do it. It happened simultaneously, but has no real causation. Correlation, yes, no causation. So thank you very much. Some of you we see at 6 o'clock at the other lesson. Thank you very much again.
Yeah.
There is a lot of interesting aspects. Whatever you're doing, you're doing correct. So I've never been, don't pay the, I have six songs.
Ti voglio dare.
It's in the center, near,
Aspetta, che allora l'esprimo che abbiamo deciso che
see whether I will. Yeah, absolutely. I look forward to it. Thank you for the invitation. I support it. Well, the voluntary one is voluntary, so the entrepreneur has to say. The other one is the some of them, you give them out. So that you and then out.
Also one
Quella rilegata.
So often the IPO is the way it's kind of like this is the right way.
Are you suggesting that the reason the decline of IPOs in different parts of the type of IPOs that are selling their own
Of the decision to release this. And this would be very.
It's in the center. I'm very clear. Converted to
never take the like bedrock but any understand
When is your plan? Your plan will be.
Mine downstairs, yeah.
No, no, aspettate, vi dovete dire lo stesso.
We are covered nine, but
Always.
yeah, it's not that it's an apartment that was converted to an hotel, so it is a hotel, but it's. Okay, I will find it.
Via Frankfurt.
Yeah,
You go with
yeah,
that.
yeah, over,
So by.